Let's start with the topic you just referenced there, the fact that Asian markets are trading on the stimulus expectations or lack of over in China. And today's move seems to be, bad data, as you say. Good data leads to lower expectations of stimulus. Yesterday looked like the opposite. But all of that at a time where some of the geopolitical lines between the US and China are looking clearer, are looking more positive. That doesn't cut through with investors.
No, it's not. I mean, I'm actually surprised we're trading off the stimulus story still. I thought we'd move beyond that, but at the short-term dynamic, we haven't. I think what's interesting is that the narrative on the global geopolitical situation, as you say, has definitely improved from a year ago. Yeah, sure, it's marginal, but it keeps on improving. And this isn't a market that's trading as if China is going to be continuously isolated from the world, and that's clearly not the narrative. Remember, we've got an EU-China summit next week, so we could get some positive surprises there. And also remember that the big Shanghai Composite trend line that's held for 20 years that we highlighted a month or two ago, that continues to hold. The market's not exactly running away to the top side, but I think still this is a narrative for the China mainland stocks that's turning slowly more positive, just not enthusiastically so.
Yeah. Let's have an update on oil then, Mark. Of course, oil was really quite volatile yesterday. It's been volatile recently, and including yesterday. Why did oil end up lower yesterday after we got an agreement to curb supply? What do we not yet understand about OPEC Plus and its intentions?
I think the voluntary compliance is worrying people, and the fact that there clearly isn't unanimous commitment amongst all the members. There's a lot of divergence in what their motives are and how quickly they want to produce. That's why we got a delay in the meeting. So I think that yesterday it had to really come with a shock and awe to get oil prices higher. We talked about this a lot earlier on in the week, and ultimately they didn't deliver that shock and awe. And because it is voluntary compliance, I think there's generally viewed correctly that the oil story is going to be more driven by demand. And that's a demand story that's definitely slowing. We might argue about how much it's slowing, and some people may not be as negative as I am in that camp, but it's definitely slowing out there on the growth side.
OK, so the demand and supply conversations to be had there. Now, we're going to hear from Jerome Powell a little bit later on today, Mark. What would make the Fed validate rate cut pricing in the markets? Because we seem to be getting still a little bit of pushback around that pricing. What are you expecting?
So I have to say, this is getting to the really problematic situation for the Fed. In the summer, we talked about how we still thought we had stocks upside and yields upside because the economy shouldn't turn negative for the fourth quarter. But we talked about the fact that you never know about recessions in real time. And the worst case scenario, we outlined this in the summer, would be the idea of a Fed that doesn't yet know that the economy is crumbling and has to sound hawkish. And even though I think the Fed is aware that the growth factors are turning down, the extreme easing of financial conditions means that Powell has to sound hawkish, even if he thinks growth is slowing. He cannot afford to reignite inflation. So I think we've got a risk of a hawkish Powell today and in the Fed in 2 weeks' time, no matter what he thinks about the growth picture going forward.